We introduced the idea of book value last time. So I just wanted to go slightly deeper into that approach. So I began going short Tesco technically. So just looking at the charts and seeing that the trend was down. Here, we're more based on the accounts. The book value appears in the accounts. And they're only going to be updated once a year, while the price is updated all the time. So here it points out, in a rising stock market, all eyes are on the income statements. But in a flat or falling market, the balance sheet moves into the spotlight. So when you're suddenly thinking about how bad could this get, or how much am I risking, investors want to know that their stocks possess certifiable take it to the bank value. So you can kind of quantify the worst case scenario. And that's what the book value is all about. As it says here, the recent drubbing among, and again, I don't know, when was this article written? May 2014. So it's not that recent. But this kind of thing, you will have periods where this happens. It's quite universal. The recent drubbing among tech and biotech stocks brought this issue right to the fore. Many of these stocks traded at 10 or even 20 times tangible book value, and had no floor in place when investors began to head for the exits. These days, less than 10% of all US stocks with market value of at least 200 million trade below book. So that's just getting a broader context. So now I'll just zoom through some other, and as always, the links to all of these are given in the description below the video, so you can look into them in greater depth if you want. Now this site is in India, or an Indian site. Savvy investors are always on the lookout for stocks that are not fully valued. But this is interesting because, it said in the previous one that only 10% of the large US companies were below 10% of book. For the record, more than one fourth stocks in the Bombay Stock Exchange are trading at less than their book value. But it says stocks may trade below their book value for several reasons, the foremost being lack of investor confidence in the company's future. If it's widely believed that the company's performance will deteriorate, its stock will possibly trade at discount to its book value. So again, in my Tesco case, one of the worries would be that Lidl and Aldi, the discount German chains, are growing, and so they're going to be taking away what was traditionally Tesco's market. Book value should not be seen in isolation. Such companies may trade at discount to their book value. So that's what I really wanted to think about, that how solid is the book value? Since there might be a recession around the corner in the UK, well then, if property prices fall, the book value is going to fall. So, it's not set in stone. Another point that I came across was straight value, salvage values and depreciation, straight line versus double declining methods. So different companies account in different ways, and that can affect, well, it's obviously going to affect the book value, because if you're accounting for the salvaging differently, the book value is going to change. So you can have the straight line method, where you go, okay, if it's going to devalue by 90% in 10 years, I'll just make it a slow and steady. So every year, I'm just going to reduce the value of those assets in a constant way. The other approach is to do it in a exponential or geometric way. So you devalue it by 20% every year. So in the first year, you devalue by 20,000. This item initially cost 100,000. In the second year, you devalue by 16,000, because that's 20% of the book value. So using the geometric approach, in the first 3 years, or at the end of the third year, your account say you have 48,800. Whilst if you went for the steady approach, your book value would be 73,000. Sorry, against 51,000. That wasn't, or it devalued by 48,800. So depending on how the company wants its book value to appear in different circumstances, you would use the different approaches. You want to kind of know the background of your company, like which way are they doing it. Finally, and of course you can keep going on and on and on, but this is just more introducing some leads that you might want to follow up. Earnings, blah, blah, blah. So any company's financial statements, public companies. Amongst these, book values and price to book ratios are staples for value investors. The point I wanted to make here, it talks about value play or value trap. Deceptive depreciation in book value. We talked about that. Actually, that was the link we looked at. So you need to know how aggressively a company has been depreciating its assets. If quality assets have been depreciated, faster than the drop in their true market value, you found hidden value. So if you look at it and go, oh, they've devalued a certain asset by far more on their books than actually they should have, that provides you with opportunity. So the kind of companies most suited to book value plays, of the kind I'm thinking perhaps Tesco are. So they are old. Old companies have usually had enough time for assets like real estate to appreciate substantially. They're big international companies with international assets. can create book value through growing in overseas through growth in overseas land prices or other foreign assets, they're ugly. A third class of book value are the ugly companies, to do something dirty or boring. The value of wood, gravel and oil go up with inflation. While many investors overlook these asset plays because the companies don't have the dazzle and flash of growth stocks. So that's, I think Tesco does fall more into this kind of category. Not so much ugly, but they have, it's an older company. They have assets which would have gone up in value. The main takeaway I wanted to end on was book value shopping. So looking around for companies whose share prices are below the book value and kind of going, oh, this is a bargain, is no easier than other types of investing. It just involves a different type of research. The best strategy is to make book value one part of what you look for. You shouldn't judge a book by its cover, and you shouldn't judge a company by the cover it puts on its book value. If you have any thoughts yourself, please comment below the video, and remember to subscribe to be updated when new content is added. Thanks.